A very good afternoon to everyone. Thank you for joining this webinar where we'll be talking about two new NFOs which Mirai Asset is coming out with. And indeed, these two NFOs are very interesting asset allocation product. So, we are coming out with Mirai Asset Multi-Factor Passive FOF. We will be discussing about this product first. And we are also coming out with Mirai Asset Gold Silver Passive FOF. We'll be discussing about this product in the second half. Both the products are starting, the NFO of both the products are starting on 11th of August, which is today, and closing on 25th of August. Now, both of these are an allocation product in a fund of fund structure, which will be investing in underlying ETFs. Now, when it comes to equities, the fund of fund has absolutely similar taxation to a normal domestic equity mutual fund if they invest in only domestic equity ETFs, which this fund of fund is going to do. Also, you will be sorts of be guarded from any tax incidents which would have happened if you would have done the asset allocation changes by yourself. Same is true for gold silver passive FOF. There is a tax advantage compared to doing the asset allocation by yourself, because when fund of fund buys and sells underlying ETF, there is no tax incidence, whereas you as an investor, if you do buy and sell, there may be a short-term capital gains or a long-term capital gains. So let's start talking about multi-factor passive FOF. So we all know what are factors and what are various strategies and styles which are being used in equity investing right now. They have become really popular. On the passive side, the idea of smart beta investing or factor investing is to identify a particular style, a particular character, and to invest in order to target that particular style or strategy. Right? For example, momentum, value, low volatility, equal weighing, etc. So in momentum, instead of investing in, let's say, a top 50 companies like what you do in Nifty 50 ETF, you invest in stocks which are having high momentum, and even the stock weights, the quantum which you will invest in a particular stock is sorts of derived based on their factor score or strategy score, how well they are doing on a given parameter. And that is what is known as smart beta investing or factor investing, right? This has grown really popular in India in last 5 years. Globally, this has become popular in last 20 years or so. So, for example, when it comes to factor, it is low volatility, quality, growth, alpha momentum, value, dividend yield, etc., etc. Right? And people typically invest in them in order to target a certain behavior. So, for example, people who are okay with higher risk and want higher rewards invest in momentum based strategies, right? Because these strategies can give good returns, can have and will have higher drawdowns, but people are okay with it, and that's why a lot of people invest in it from a long term point of view, right? And then there are defensive factors like low volatility, which typically falls less when markets are correcting, and by falling less they in the end generate alpha by having a lower drawdown over a long period of time. uh, these strategies have become popular so much that 5 years back, their AUM was only 300 crores, and now it is more than 46,000 crores. Most of the money coming from retail, HNI, family offices, PMS, etc. But see, there is one very unique characteristic and behavior which we all should be aware about. And to be honest, recent market behavior have made people aware about it, right? That factor investing requires a lot of analysis to choose a right factor for yourself, but it requires sorts of a very patient mind also, because factors perform well in a cycle which is conducive to them, which is relevant to them, but they can underperform also in a sorts of in a market regime which is not in favor of it. So for example, momentum does really well in a bull market, but it does equally poorly in a bear market, right? If there is a multi-year bull run, you will see momentum outperforming the underlying index, a benchmark by double-digit percentage, right? But then if markets are correcting, you will see probably momentum underperforming the benchmark by 10-15% or so, right? Even higher probably. The idea why momentum investing is very popular is because in India we're lucky to be in a place where we see more bull runs than the bear runs. So over a longish period, momentum does well, but it scares people due to its drawdown, right? So can you sorts of weather the drawdown which momentum factor shows? Same or rather contra thing happens when it comes to investing in, let's say, a low volatility, which is investing in portfolio or stocks which are more stable in nature, and it has, let's say, probably from a performance point of view, not very exuberant performance. It outperforms market by 1-2% or so in the long run, but never by as much as momentum does, right? But it has a lower drawdown. If you look in the long run, you'll typically see it has a lower drawdown than Nifty 50, which means it falls less than Nifty 50, Nifty 100, etc. And it has lower volatility also. But one more point which people should note is that it may be biased in favor of defensive stocks. Just imagine low vol will consist of FMCGs, healthcare, couple of private banks, couple of large cap companies which tend to be more stable from their price performance point of view. We all know which, and typically your portfolio will be made of those set of companies. Value, on the other hand, can be very cyclical, right? You can have phases when value is doing phenomenally well, and then you can have multi years when value is doing nothing, or having a or is in a correction zone, and equal weight also. For example, if markets are very concentrated in nature, equal weight can underperform. Just remember 2018 when only top 10, top 15 stocks were doing well. And equal weight also depends which segment you are targeting. A top 20 equal weight is defensive in nature because it is only investing in top 20. A Nifty 500 equal weight will be very aggressive in nature because most of the allocations are happening in mid caps and small caps, and that to higher allocation relatively in smaller stocks. So it depends where equal weight is investing. So the point which I'm trying to make is all these factors, all these style strategies does really well, but it comes with the issue of cyclicality, and at times it comes with the issues of sectoral bias. For example, quality portfolio is very biased against BFSI. If you look at Nifty 200 quality 30, Nifty 100 quality 30, the weightage of BFSI in Nifty 200 quality 30 is roughly around 2-4%, which is much lower than what market representation of BFSI is. So at times, that biasness also can impact you negatively, right? But we all like factors, right? Because if you look in the long term, factors have done really well. For example, if you look at this CAGR performance and this is June ending data, let's look at 10-year performance. In 10-year, Nifty 500 has given 14.4% return. Your term has outperformed it by 5.3% on a CAGR basis by giving a performance of 19.7%. Value has given 17.9, equal weight has given 15.7, low vol has given 15.8, which is again a 1.4% higher returns. And imagine all this with lower volatility. And then comes quality, which is around 14.9%, right? Not so much, but okay. Even if you look at, let's say, a 3 year data, which is, let's say, a more recent time horizon, you will see that Nifty 500 has given 22% return, but value has given 39, momentum has given 29, etc. Right? So factors have done well in the long run, because if you get few cycles or few periods which are aligned to a particular factor, your your alpha which is being generated, the outperformance will be significant, and that's why over the long run these factor performance numbers look so good. But one is investing, and second is to whether the cyclicality of it, right? There are so many people who invested in momentum, in strategies in 2022, 2023, in 2024 also got phenomenal returns. But as soon as the drawdown happened, which happened from October till March or so, where momentum and alpha corrected by let's say 25-30%, when markets were down 15% or so, people panicked, right? Because not everyone is okay with drawdowns, and that is very important to understand, right? If you are willing to stay invested over the long run, you may generate reasonable outperformance, but the issue of correction, issue of bad timing, issue of entering at a wrong point will always be there. So, and you may have a bad experience also. Just look at this chart, which talks about which factor is performing when. The light gray is Nifty 500 returns. Anything on top of it is giving excess return. Anything bottom of it is giving bad return. 2023 and 24, momentum was one of the best performing factor. 22 itself, it was the worst. 21 best, and in 2020 it is just borderline positive. 2019 negative, 2018 negative, 2017 best again, 2016 worst, 2015 again best performing factor, right? So just see the cyclicality. If people are investing for shorter duration, etc., or coming at a wrong time, they may have a bad experience with a particular factor. For example, if someone would have uh, let's say invested in 2007 in momentum, 8 and 9 were fact, momentum was one of the worst performing factor. If somebody would have invested in, let's say, 2015 and 16, would have got a very bad experience. So that sort of thing can happen in factor investing. Similarly, when you look at other factors also, like value, just look at value doing being one of the best factors recently, but look at 2018, 19, 15, look at from 11 till 11, 12, 13. Just imagine anyone who invested in a value based fund in 2011, in 2010, saw value being the worst performer in 11, 12, 13. Imagine what it would have done to his portfolio, his investment psychology, etc. Even when we look at absolute return, you'll see that while in the long run these have done really well, and in the short run also, it can have a huge issue of cyclicality. For example, you see that momentum gave return of 78.9% in 2021, but immediately gave a highest negative return of minus 7.6%. It gave a fantastic return of 69.5% in 2017, but immediately it gave a negative return of minus 10.7. Same with value, gave a phenomenal return of 47% in 2017, but a very large drawdown of 26% in 2018, and then again in 2019. So the point which I'm trying to make is that factors are very good, right? But if you're playing tactically, if you're playing for a short term, timing matters, right? It is very important for value, for equal weight, for momentum to enter at the right time. If you're only investing for a 3 year horizon or a 5 year horizon, right? If you are investing for a long term, then you should be ready to sorts of uh, uh, whether the drawdowns, right? You should be ready to take the volatility, etc. And all this creates sorts of emotional drawdown, right? People do not nobody likes underperformance. So while factors do so well in the long term, it test investors patience, and that is what we have seen also, right? And that is where we are coming out with this fund. The idea of coming out with this fund is to launch a product which will take all the calls, where to invest, how much to invest, and how to shift in different smart beta products, so that you don't have to, right? Because if you do it by yourself, you can have the issue of taking a bad call in terms of timing, investing in a wrong product because there are so many options which are available, and also the tax incidents, right? If you are changing the allocation by yourself, STCG of 20% will apply, or a LTCG of 12.5% will apply. That sort of, in for any allocation shift, if you are doing by yourself, for fund of fund, all those don't apply. So ultimately, it's a tax advantageous way to sorts of manage the asset allocation. And this grid, you can see how significant the tax impact is. So we are launching this multi-factor passive FOF, which will not only try to time the market, right, but will do it in a very in an in an in on a basis of asset allocation grid, right? So we are trying to do both things. First is identify what sort of market it is, whether it is a base regime, a moderate regime, a frothy regime, etc., whether the valuations are okay, whether market sentiments are positive, or valuations are too high and market sentiments are negative. All those things will be done in step one, where we are trying to identify the market regime. So market regime will be identified, right? And then there will be factors which will be suited to a certain market regime, and will go over allocate or allocate more in that particular products which are relevant or more aligned to a given market regime, right? And allocate less in the other products. This we are deciding by asset allocation grid. We are saying that in a given market regime, some products will have higher allocation and some products will have lower allocation, right? So it is very important to decide that in a diversified and a systematic manner. That is where allocation grid come into picture. I'll talk about it, and using both, we have come out with this hybrid approach. And the last step, we'll be further looking at individual factors and tilting it. If a factor is not performing better, we'll reduce the weight and increase the weight in factor which is performing better. So let's look at step one, which is market regime. Right, I talked about the fact that there are factors which work better in a bull run, right? And and factors which is where it is better to invest when valuations are on the lower side. For example, equal weight, for example, momentum, for example, value, which is a cyclical product which works very well in the bull market and has a higher drawdown in a bear market. On the contrary, if you want to play defensive, you invest more in low volatility, you invest more in, let's say, a top 15, top 20 product, where allocation is more so on the mega cap companies, and also, let's say, in a Nifty 50 equal weight, which is a large capish product, investing equally in all 50 stocks, right? So we have to identify the right regime, because when we identify the right regime, right markets, we can pick out the right allocation grid. So we do that by looking at multiple factors. In the step one, we try to identify a market regime. So we look at valuation, we look at VIX, we look at advanced decline ratio, we look at Nifty volatility, returns, microcap outperformance over over the 500 universe. And by looking at all these factors, we decide whether the market is in its base zone, which is things are okay, valuations are okay, sentiments are okay, whether it is in a moderate zone, which is valuations are a bit elevated, right? Or whether we are in a frothy zone where markets are valuations are elevated, market sentiments are a bit negative, shrinking, etc. And lastly, we also look at a drawdown regime also, that let's say markets have corrected by more than X percentage, and we need to probably change the allocation to take advantage of correction. So on the in this table on the top side, you can see the regime which are being identified. Like I mentioned, base regime, when markets are attractive from a valuation point of view, from a sentiment point of view. Moderate, when valuations are a bit elevated, sentiments are okayish, right? If markets uptrending, sentiments will be bullish. Froth market, when market sentiments are turning negative or are negative, and valuations are on the higher side. And the drawdown regime, right? And then we have identified for allocation rate. So first step, we have identified the market regime. Second, we have sorts of said that these set of uh, factors are defensive play, and these set of factors are aggressive play. For example, top 15, top 20, equal weight Nifty 50, low vol 30 is a defensive play. Aggressive play is BSE 200 equal weight, mid small cap quality momentum, alpha 30, value, etc. are aggressive play. And then depending on regime, we are allocating in defensive and aggressive factors. For example, very intuitively, in base regime, we are allocating more in aggressive factors, around 70 to 90%. When the regime becomes moderate, where valuation are a bit higher, we are going 60-80 in terms of allocation in aggressive. Then 40-60 when market becomes frothy, right? We are playing defensive and aggressive almost in the 40 to 60 zone. And then a drawdown regime, where again we are going and allocating more in aggressive factors because we want to take advantage of market recovery. Now once we have classified it, on the top grid you can see that which factors will sorts of contribute in terms of allocation. And to make things simple, just look at Nifty 100 low vol 30 product. In the base regime, it will have a low allocation, which is, let's say, 0 to 5%. In moderate regime, it will have a bit higher allocation, let's say 5 to 10% or so, plus minus X amount. And in the froth regime, it will have, let's say, a baseline allocation of around 15% or so, hypothetically. So from 5 to 10 to 15 is how low vol contribution is increasing, because markets are becoming more expensive in nature and more frothy in nature. On the other hand, you'll see that alpha, or look at value, is allocation is decreasing as the markets are becoming more expensive. So that is how the allocation grids are, right? You'll see the defensive allocation is increasing, your aggressive allocation is decreasing as the market is becoming more and more expensive. And then in drawdown, we are again going a bit more aggressive. So this is how the allocation grid works. And then final step, which is the third step, is that then we look at individual valuation and risk adjusted performance to further tilt it in favor of a factor or against a factor. For example, let's take example of low vol 30. Markets were in frothy zone, let's say in December 2024, right? High valuations, very negative sentiments, frothy zone. So let's say the baseline allocation based on this grid is somewhere around 15%, right? 50, let's say it's 15%. Now again, I'm running a valuation and a risk reward check on low vol 30, and I'm looking at that in December 2024, the valuations were still high, low vol was not performing. So instead of 15%, the allocation will reduce to a lower level. and let's say top 20 was doing well, or top 15 was doing well, the allocation will shift from, let's say, 15% to top 20 to a higher allocation. So in this frothy regime, low vol will have a relatively lower allocation, lower than its baseline, and top 15 will have a higher allocation from its baseline. So those are the three steps which is being followed to do the asset allocation. One is regime identification, which market we are in. Second is looking at the asset allocation grid to identify a baseline allocation, and third is finally looking at valuation as well as risk and momentum to further tilt it in favor of a factor or against a particular factor. So all this is being done by the model itself. The idea is to give performance which captures the upside of factors, right? So because it is investing in alpha, in value, in equal weight, etc., to capture the upside which these factors give when there's a bull run, etc., but also to protect the downside by investing in defensive factors like low volatility, uh, 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 top 15, equal weight, etc., when the markets are in a correction zone. So the and since all this is being done in a fund of fund, it is relatively tax advantageous also if this was done by yourself. So anyone who wants to invest in factor and styles, wants to capture the upside of these factors and style, can explore this particular fund of fund. Hopefully we'll have a lower drawdown. So thing is that it will always sorts of try to capture the upside, but will never be the best performing product if you're comparing it with single factors, because there'll always be one factor which is doing really well. And then on the drawdown also, the idea is to sort of protect it and be somewhere in the middle, right? So that is the intent of this product, to have a better return to risk profile by switching between the factors. Very quickly, like I mentioned, that this will be investing in ETFs. So we'll be investing in not only these ETFs, if possible, the list can expand in future also. So for example, we don't have Nifty top 20 ETF as of now. Mira will launch it eventually, but as of now, we'll be, let's say, investing in a Nifty top 15 or a Nifty top 10 ETF if you want to take that exposure. We don't have a value product, so we'll be investing in some others AMC value 30 or a value 50 ETF. If going forward, there's a very good quality ETF also, we may add that allocation in the defensive zone. As of now, we don't like any product which is there as a pure quality play. So all this allocation will be managed like I mentioned. So you can choose this particular product if you want to capture the upside, want to mitigate some of the downside, uh, don't want to worry about timing the factors, etc., is more tax efficient in nature. So if you have any further questions, please post in the chat box. I'll take it in the end after covering gold and silver allocator also. So let's move to Mirae Asset Gold and Silver Passive FOF. I think there is huge interest in commodities and precious metals right now. They have performed so well, so why not, right? So gold did really well till the start of this year. Still, I'm like, it is consolidating now, so you're not seeing upside momentum which we saw huge momentum in last 2 3 years, and that conversation has now shifted to silver. So earlier it was gold, now it is silver, and this fund basically tries to answer that question, right? So gold, we all know, is a strategic hedge across regime. It's an anchor metal. It should form part of every investor's portfolio, right? It's such a good asset class to own because it has lower correlation with equities. It sorts of reduce the overall volatility of your portfolio, and things which were working in favor of gold, like geopolitical risk, dollar weakness, higher inflation, distribution, etc., and obviously elevated central bank demand, obviously sorts of propelled the gold to new high. On the other hand, silver is very volatile in nature. So please, my session will be, don't treat gold and silver when you're investing individually with the same same metrics, because silver can be very volatile. Silver usage is also different. It is primarily driven by industrial demand, etc., and that because of that it can be highly volatile. Also, one thing which is supposed to obviously buffer the silver volatility is the demand supply imbalance, where supply is actually in deficit. So gold and silver makes a perfect sorts of field to launch an allocation product, and that is what we are doing. Gold stabilizes, it also creates wealth, but also acts as a stabilizer. Silver amplifies. There will be opportunities when silver is doing really well, and that is a time when you have to allocate more in silver, and that is what this particular fund wants to do. I'll just uh, quickly move across these particular slides. Like gold typically works well post rate cuts, etc., that we have seen historically. Not true all the time, but we are talking about majority scenarios. Gold acts as a safe haven in times of geopolitical stress. We have seen that recently. Gold also strengthen when dollar weakness is there. People tend to sorts of take shelter in gold asset class. And more importantly, recently we have seen that how important are central banks, which are driving the demand in gold, predominantly emerging market countries like China, India, Poland, etc., driving bulk of buying in gold. So much so that in last 3 years we have now seen more than 1,000 tons being purchased by central banks, and I think that is something which probably we are going to witness in future also. Whereas on the silver side, like I mentioned, predominantly driven by industrial demand. You have high usage in EVs, solar, photovoltaic growth, etc. There's a supply deficit, which is probably supporting the silver prices also. And obviously, when you look at gold silver ratio, which is one of the input for what we are doing also, you'll see that even now silver looks attractive from a gold silver ratio, and gold silver ratio in a way portrays the investment opportunity also. So the way it works typically is, if gold silver ratio is on the higher side than the historical average, basically the understanding is that gold is relatively overvalued, and if gold silver ratio is smaller, it seems like that silver is overvalued relatively. So that is how typically people also look at gold and silver ratio. And timing in gold and silver is very difficult, right? People believe that timing is easy. So first look at the fact that if you draw the return distribution, silver has fatter tails, which means that probability of happening extreme events for silver is much higher, right? So that is very important to understand, because a lot of people invest in gold because they want stability also. Please do not expect that from silver, right? So because silver has fatter tails when you draw a return distribution. uh, Also, one thing is that you can have long period of nothing happening in a commodity, right? So it happened for gold also, it happened for silver also post 2011, when silver didn't perform for years, and that is something which can sorts of create an issue of proper timing. And this is also very important, right? Like I mentioned, for factor allocator, since all the changes in gold allocation or silver allocation is happening using the fund of fund, it will give you more tax advantages. For example, if someone is doing it by himself, let's say buying and selling silver depending on price movement, he will be exposed to STCG, right? Which gets applicable as per your tax slab. No such thing happens when the FOF buys and sells. So there's a direct impact of taxation also, since in case of FOF, tax impact is not there. So it makes a lot of sense to blend gold and silver and offer a solution product to investors. Gold as an anchor metal, silver as a cyclical metal with reasonable upside, and to move around in a manner which sorts of captures the upside somewhat, right, and mitigates the downside. So how the framework will work is that we will from a base start at 50% allocation to gold, 50% allocation to silver. That will be the initial intent, right? So we'll be treating gold and silver equally. So that our base allocation इंटेंट विल बी कि अगर सब सही है, everything is equal, gold and silver, price movement expectations, valuations, outlook, etc., if everything is same, gold will have 50% of the allocation, silver will have 50% allocation. But that is not the case, right? So then we will look at initially uh, near term and short term momentum, right? And risk adjusted momentum kitna hai, or how well is gold doing, how well is silver doing in a near term and a short term period. And then we'll also look at gold and silver ratio for short term and medium term. What is the valuation of gold silver currently compared to its short term average, and also compared to its medium term average. So what we are looking at near term and short term uh, momentum, risk adjusted momentum, and we are also looking at short term and medium term comparison with gold silver ratio. So what that will tell us is, based on gold silver ratio, based on momentum, where you should allocate more. So for example, roughly model is telling right now 53-54% allocation, let's say, in silver, and 46-47% allocation in gold, right? So go more towards silver and lesser towards gold, right? And in a very range bound manner. Then what will happen, that our fund manager will also look at other technical and fundamental factors like geopolitical risk, any Fed policy updates or change in market expectations around Fed policy. Probably look at what is happening on the tariffs, etc. Because all these things also affect gold and silver, which cannot be in a way quantified into a framework. So based on all this, the fund manager may further tilt the allocation in favor of gold and silver depending on his view on gold and silver. So one is obviously what the numbers are saying based on momentum, based on gold silver ratio, etc., and then what the fund manager view is based on looking at all these fundamental and technical factors, and then the final allocation will happen. So right now, for example, if things are looking good for silver, etc., and we are sorts of expecting gold to consolidate, probably not correct, but consolidate. The fund can go, let's say, a 60%, 65% in silver, and 35-40% in gold. But if the feeling is that silver has already run up now to almost $38-39, there might be some respite. Tariff will still sorts of play out, etc. So silver may end up having only a 50%, 55% allocation, let's say, and remaining 45 in gold. So all these permutation combinations will happen depending on how momentum is looking, how gold silver ratio is looking, how other technicals are looking, how fundamentally we are looking, reading gold and silver in related to geopolitical issues, Fed policies, etc. So that is how fund will change the look at the allocation, change the allocation. So there are a couple of products in the market. When we look at them, they seem more static in nature in terms of allocation. One does 70-30, one does 50-50. Ours will be a bit more dynamic in nature, right? Tilting towards the asset class which has a better outlook, better valuations, and better momentum. So when we are comparing this allocation to a 50-50 50-50 gold silver allocation, just to sorts of show you how how the performance will look. So, for example, you can see that in 10 years, 50/50 is giving around 14.1% return, which is more than what silver gave at just 12.6, less than what gold gave around 14.8. But if you look at, let's say, a 1 year, 37.9% return. If you look at 3 months, right, a 10.7% return, which is much more than what gold gave at a 4.4% return. So 50/50 allocation typically helps in sorts of participating in both the commodities. Like I mentioned, that we'll follow a dynamic allocation where there will be a range bound shifts in gold and silver depending on where the outlooks are. Outlook is better. Even on the volatility side, if you are mixing 50/50, you'll see that substantial decrease in volatility when you are comparing with a pure volatility numbers of silver. This is historical data, which will also tell you why allocation in gold and silver makes uh, playing it through asset allocator makes so much sense. Because if you look, for example, silver, like in 2010, gave 71% return, 9 gave 50% return, in 2020 gave 44% return, but then it fell also by 16% in 2014, 23.5% in 2013, almost 8.2% 2021, right? So it had a higher drawdown. Gold, on the other side, probably don't have so much of an upside like how silver has, right? So its highest calendar year numbers is somewhere around 31.7, but then it typically does not have a significant drawdown also when you are comparing against the silver. And if you look at sorts of 50/50 allocation, you'll see that on the higher side now, 50/50 allocation is 37.4% return in 2020, or 45.8% return, with a relatively lower drawdown, let's say of 14% in 2013 versus 23.5% by silver. So again, this passive FOF will invest in both gold and silver, manage the allocation dynamically, tilting towards commodity which is looking more attractive, and by doing that, it sort of takes away your uh, 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 concern of shifting towards the metal which is more attractive, and incurring a tax while trying to do so, which does not happen in case of a fund of funds. So I think both are very relevant products in current market scenario. Both multi-factor passive fund of fund, where we are allocating in multiple smart beta and factor products so that you capture the upside and reduce the volatility and drawdowns, and gold and silver passive fund of fund, where we are dynamically allocating between gold and silver to take advantage of both the commodities and reduce the downside. The NFO is opening on 11th, closing on 25th. Like I mentioned, that for multi-factor passive FOF, taxation will remain similar to what equity mutual funds has. Short-term capital gains and both long-term capital gains. For gold and silver, also it will be comparable to what gold fund of fund and silver fund of fund has. So, fund of funds are no more tax disadvantageous. And please, if you want further detail, please read our tax reckoner, which talks about the same. So that's it from me. What I'll just go at the start of the presentation, and if you have any questions, please post them in the chat box. I'll be taking them one by one. So let me just stop the sharing and look at Q&A. So what I'll do is I'll first take 5-6 questions on multi-factor, and then 5-6 questions on gold and silver, so that I'm not mixing both the topics. Yeah, so there's one question by Dollar Shah, who is asking how efficient is factor-based investing. So so I'll rather say that factor-based investing is something which invest based on uh, a behavior you want to target, right? So if you are targeting momentum, expect uh, higher reward with higher risk. And if you are investing in, let's say, a low vol, expect not so much of an outperformance with lower risk over the long term, right? So that is important. So and for short term, you have to play tactically very well, and that is why we have come out with this fund of fund which takes those calls on behalf of the investors. So let me just look at. So current regime, which as per the multi-factor which we ran did last month, was moderate. So Krishna ji is asking lump sum or SIP, which is preferable in Mirae Asset multi-factor passive FOF at this moment time horizon. I think you can do, to be honest, either lump sum or SIP, because like I mentioned that the idea of this product is to be more like a all-weather product. If markets are not well, shift towards defensive. Markets are good, shift towards aggressive, etc. So you can do lump sum or SIP, up to you. Time horizon, I think looking at the markets right now, even from a valuation, etc. point of view, I'll say anything from 4 to 5 years should be your time horizon. So there's one question by Bipin Savla. So all ETFs invested will be from your AMC or outside AMC. So I think there might be a couple of ETFs which will be from outside the AMC. Like I mentioned that we don't yet have top 20 ETF. We have not launched it. So we'll be using other AMC's top 10 or top 15 ETF. And we don't have a value ETF. So we'll be using someone else's value ETF for now. So we won't shy away from using any factor ETF if it makes sense, or if it is superior, or if it captures a particular factor in a very nice manner. So the idea is to use whatever is good for the investors in the portfolio. So one question is what is the TER, and he's asking for both the funds. I'll answer for both the funds. So uh, please do check it on the website when the products launch. But I'll give you a rough range. I think the direct plan, including the underlying, will be somewhere around 45 to 50 basis point. Uh, that will be that will be the fund of fund, including the underlying, 45 to 50 basis point. I think around 50 basis point or so, and that will be the direct plan. The regular plan, including the underlying, will be somewhere around 100 basis points, so which is 1%. I think a lot of questions which are on rebalancing also. Yes, so the model will be run on a daily basis, right? And what we'll do is we'll use the money which is coming in or going out of the fund to align the fund with the model. But see, major changes happen in case of multi-factor typically around the earning seasons, right? So if we see a big deviation because of earnings update, valuations update, etc., or in case of gold and silver moving significantly in contra direction, and you see a difference of, let's say, 3-5% or so in what model is saying and what our allocation is, we'll do the allocation shifts. Now let's take couple of gold and silver questions also. So what will be the ratio between gold and silver, and will it be balanced dynamically? So that is Dollar Shah asking. So yes, so our baseline allocation is 50-50. That is where from we'll start. So we are treating both the asset classes equally. Then we are looking at gold silver ratio, short term, mid term. We are looking at momentum, near term, short term, and we are looking at we are looking at other fundamental and technical parameters also. So we can, like I mentioned, that this entire allocation will be dynamic in nature. So for example, right now maybe we'll go 55-60% on silver, and 40% on gold, depending on what the model is telling and depending on what our fundamental and technical analysis are telling. But this will be done on a regular basis. So we'll be running the model on a daily basis, being aware of what is happening in gold and silver market. So again, I think there's some confusion where Hari Ramachandran is asking, when gold silver ratio is clearly favoring a value towards silver in terms of price, why the fund still treat to have equal weight as start of the fund? So that is not the case. I'm just telling you how the process will start. So the starting point is 50-50. It doesn't mean that we'll allocate 50-50. The model which is on which it is constructed thinks that everything is equal. So before getting all the valuation numbers and momentum numbers and macroeconomic numbers, etc., it says that if everything is perfect, I'll do 50-50. And then we start feeding in the information that momentum is this, valuations is this is this. And then it says that, okay, then we come to a decision that, okay, 50-50 is not right, because like you said, that silver is looking more attractive. So perhaps we'll tilt towards silver by having a higher allocation towards silver and lesser towards gold. So there's one question by what is will be the extreme allocation to either gold and silver. So probably on the max side, let's say 80-20 towards gold and silver, which when we did some of the back testing based on simply gold and silver ratio and momentum, because you cannot go back in history and tell what fund manager call will be. I think based on gold silver ratio and momentum, we were looking at a 65 to 70% allocation toward tilt towards one of the commodity. So perhaps I'll probably take a leeway of 5-10% more and say that somewhere around 75-80% in one of the commodity can go in extreme allocation scenario. Let me just I'm just browsing through more questions. I think I have answered most of the questions, because they are somewhat similar. Yeah, so there's one good question. What happens if the performance of gold silver prices stagnant for 5 years around current level? Answer is that returns of the fund will also be stagnant. For example, for next 5 years, both of them behave like a debt and gave around 7% return, both gold and silver, with very similar correlation over and down. So ultimately, this is an allocation product. It will give similar returns, right? To what if that stagnation hypothetically happens. So good evening. In near term, you are expecting price correction in gold? That's a question by Dhani Konda, Mahesh Kumar. So no, I am not expecting correction in gold per se, but I am expecting it to remain range bound. I think current levels plus minus some movement here and there. It will consolidate and it will remain range bound for some time. I think it has already, we have been saying that since last 3 months or so, and our call on that has been correct, that gold has remained range bound. Why? So Akshay Unai is asking why is this called passive fund when it seems to be actively managed based on market conditions. So it is called passive because the underlying which we are using is are all ETFs. So that's why it's passive. Good thing is also which I forgot to mention. So thank you Ashok for reminding me that here we are not taking stock calls. So there have been several multi-factor funds, but they have to not only take call on which style strategy is working, but also on stocks also, that if I have invested in XYZ stock and let's say value is not working, so should I sell this stock? By how much? Is this stock a value stock or a quality stock? What if it is both? Should I sell it? How much do I sell it? Here, we since we invest in ETFs, if I have to completely exit value, I'll simply sell value ETF. So that sort of helps and take away that stock specific risk when I'm sort of rotating between factors. Like I mentioned, so GV Krishanji is asking asset allocation among ETFs on quarterly or half yearly basis. Like I mentioned, that we'll be running the model on a regular basis, almost daily basis, because see markets do not change their behavior on a quarterly basis. It can happen any day, right? It's prudent to run model on a regular basis. Though most of the changes at times when model is when allocation is based on valuations also happens based on allocation based on valuation, and valuation change typically happens when earning seasons is there. So it may happen that most of the allocation changes around earning seasons, or if market has moved very widely, and hence but we'll be running the model on a regular basis almost daily. I'm not. So I think ICICI thematic advantage FOF invest in other themes also, right? I'm not sure, to be honest, 100%. That's one of the questions which is being asked, whether this fund of fund is similar to ICICI thematic advantage FOF. I think they are playing around themes, etc. This is predominantly investing in in smart beta ETFs and funds only. So it will not even invest in Nifty 50 ETF or let's say any sector or a theme ETF. Only pure play, uh, not pure play, but only in factorial ETFs like low vol, value, equal weight, quality, alpha momentum, growth, etc. All dividend yield, etc. May be considered. I think there's one question which is I have invested in EV India ETF at NFO time lump sum. So can it be proper to switch this current multi-factor NFOI? So I think while I understand your question that auto segment as a whole has sorts of corrected, and that is why probably your investment might be showing negative returns because the auto has corrected significantly. So both the products are very different, right? One is auto centric. So one strategy you can look probably is look at probably buying at dips and accumulating a bit more units and taking advantage of correction when it happens in auto segment, etc. Though I feel that that particular segment can remain volatile for some time. Multi-factor switch is completely different if you want to move away from a theme play or a sectoral play and move into an all weather product like a multi-factor. Probably you can explore doing so. I assume that if you're in a loss, it will not entail a tax implication. That is one call you may take, or you can probably look at staying invested in that particular fund, perhaps adding a bit more. But like I mentioned, that I expect that segment to continue to remain a bit volatile. There's one question from Dhani Konda Maheshwar who is asking, sir, on a redemption time, if the client wants gold in physical mode, is it possible? So not from this fund of fund. So this fund of fund will only do sorts of uh, uh, cash redemption. Gold in physical mode cannot be obtained when if you are investing in this particular fund of fund. So I think we have run out of time. It's already 5 o'clock. So thank you so much, everyone, for joining this webinar. If you have further questions, please contact us through various available mediums like Twitter, etc., or contact your RM. We'll be more than happy to clarify any doubts pertaining to either of the offerings. Like I mentioned, that multi-factor passive fund of fund is great product for someone who is looking to invest in a smart beta product, but conscious about the drawdowns and volatility. So that's a great product which captures the upside and mitigates some of the downside. Gold and silver is very good product for someone who's looking for allocation. Both gold and silver will be doing the allocation and managing the allocation in a dynamic manner. So if someone is looking for that, this fund of fund will make a lot of sense. And in both the cases, since fund of fund is changing the allocation, it will be relatively tax advantageous, because that will not invoke tax incidents, because fund is managing the asset allocation by itself. From a taxation point of view, things remain similar. FOF is not tax disadvantageous, and from a cost point of view also, I mentioned that direct plan including the underlying will be somewhere around 45-50 or so basis point. Please check. I'm just giving a rough number. And regular plan will be somewhere around 100 and 105 basis point, which is 1% or 1.05%, including the underlying. So cost wise also it makes sense. So hope for your participation. Please do get in touch with us if you want any further clarifications. And thank you for joining this webinar. I hope you have a wonderful day and week ahead. Goodbye.